Greetings from beautiful downtown St. Louis, Missouri. We are Anders CPAs and Advisors based right here in downtown St. Louis, but serving businesses and individuals not only in the St. Louis area, but across Missouri and across the country. My name is Dave Finklang, and I have the pleasure of being your host this afternoon. On behalf of all of my partners and all of our colleagues, we'd like to welcome you. And beyond that, we'd like to say thank you for joining us. We know everyone these days is stretched very thin for time, and we appreciate you sharing an hour with us. And myself and our team, we promise to make this a valuable hour for you. So this is our 6th webinar as part of our COVID-19 economic stimulus webinar series. So it's hard to believe in such a short period of time we've had 6 of these, and I can almost guarantee we're going to have more as things unfold. If you've joined us in the past, thanks for joining us again, and for any first-time viewers, welcome. I will say that the focus of today is going to be on the Payroll Protection Flexibility Act that was passed last week by the Senate and signed on Friday by the President. So we're going to spend most of our time speaking about that. There are other parts of the PPP program related to eligible costs and expenses and a lot of time frames. Those, if you want more detail on, we'd invite you to visit our COVID-19 Resource Center at anderscpas.com. We have all of the prior webinars recorded for you, and we have a lot of written material, be it blogs or be it articles for you to reference there. So again, we really want to focus on the key changes. And the reason we do is, quite frankly, we're pretty excited about some of these changes because compared to prior webinars where we've had to deliver maybe less than favorable news, I think a lot of the news you'll hear today is actually very favorable for businesses. It's going to make it, as the act would imply, a little bit easier for you, a little more flexible for you to achieve loan forgiveness. More so than that, with some of the extra time we've got, I think this is going to give us all as business owners the opportunity to maybe pause for a second and really make some more strategic business decisions with our PPP funds, rather than some of these, call it knee-jerk reactions we've all had been making along the way. So with that, I do want to introduce several of my colleagues presenting with me this afternoon. So for those of you joining us again, you'll recognize a lot of these faces. And for those new, well, let me introduce you to my colleagues, Dan, Rebecca, Dan, Paul, and Chad. They'll be presenting with me this afternoon. And then on the next slide, would like to talk about, I always kind of like to call them our wizards of Oz behind the screen here. So our Q&A panelists today, our colleagues Jane, Lori, and Abigail. So again, for those that have been with us before, you'll see in the bottom of your Teams app a chat functionality. Please feel free to submit Q&A or a question for our panelists. I will say from past webinars, we get hundreds of these questions every webinar. So we're going to do our darndest to get back to all those questions. What we're going to try to do this time is really try to pick the questions that have broad applicability to many businesses. And we're going to try to focus on those questions first, just since that will hopefully benefit more folks on the webinar. That said, if you have a very specific question about your business or your situation, we'd be happy to follow up with you after the webinar to talk about those in more detail. If you'd like to take that approach, we'll share our contact information at the end of the webinar. Or if you do want to submit a question via the chat, please just give us your contact information and one of us on the team will follow up afterwards. So with that, before we jump into the full webinar, I will mention this webinar, like our past webinars, will be recorded. So we will share that with all the participants today. So if you're not able to jot down those notes fast enough, don't worry, we'll get this out to you. So the first slide I do want to touch on is the agenda for today. We want to give you a little bit of a roadmap of where we've been because it's quite frankly the craziest roadmap I've probably ever seen in my life. And I used to fly airplanes for a living, and seeing the way this thing is unfolded and the twist and turns has just been pretty crazy. We're going to spend a bulk of our time talking through some of the provisions that changed. And then as you can see, we're going to share a few other things with you today, particularly some of the other loan programs and some of the other benefits. So with that being said, I would like to show you the roadmap we've been on here. Since the CARES Act was passed March 27th, we've had 32 different changes or different iterations of this program, of the CARES Act and of the PPP program. So many of you have been experiencing this map along the way with us. Some of you are new to it, some of you jumped in the middle. But as we've just all seen and experienced, this has been kind of a roller coaster ride. But what I like to remind myself when it gets frustrating is, the ends hopefully justify the means here. Hopefully the outcome of mostly for forgivable loan, or hopefully a forgivable loan for your business, kind of makes this all worth it. With that, I do kind of want to share the next slide. A client of ours sent this slide to us, or it was really a meme, and we converted it over to look a little prettier, but shared this slide with us. The rules about the rules. And if you read through it, I don't get to see your faces, but hopefully a few of you will chuckle as you read through this, because it really does kind of just reiterate what we've been through the past 3 months here. They're constantly changing. They're always reverting back to somewhere else. And in fact, yesterday on the 10th, it wasn't an interim final ruling, which I always kind of laugh at that. It was a revised interim final ruling. So it's just an oxymoron wrapped inside of an oxymoron. So that's how we got to where we're at today. A lot of changes have got us to today. And with that, I think the first provision we want to talk about, I'm going to hand off to my colleague Rebecca to talk to one of the most popular things here in the change in what we call the covered period. So Rebecca, can you please talk us through that?
Yeah, absolutely. So one of the biggest changes, as you alluded to, Dave, is that the covered period now can be expanded from 8 weeks to 24 weeks. Any PPP loan that was in place before this law was enacted, before June 5th, can choose whether to use the 8 weeks or the 24 weeks. Any PPP loan that's gone into place after that will use 24 weeks. And the covered period either way will not go beyond December 31st, 2020. So if we look at the comment on the screen about costs paid and costs incurred, so that's not a new rule. That's something that we've been talking about, but just wanted to bring that back to the surface. So that means that we can use our PPP funds on expenses that we pay during the covered period, no matter when they were incurred, and that we can use them to pay maybe after the covered period for expenses that were incurred during the covered period. So if you think about it from an accounting perspective, we use kind of cash basis at the beginning and then accrual basis at the end. So overall, the 8 weeks being expanded to 24 weeks gives us a lot more flexibility, that we can pause, we can take time to make decisions. There's other impacts, and we're going to walk through some of those, but maybe it makes sense, and maybe it's a really great opportunity that we can use 24 weeks now to spend our funds. Also wanted to mention that the deadline to apply for a PPP loan coming up very quickly is June 30th. So if you've not already looked into that, but you are interested, I would reach out to your banker as soon as possible. So now I'm going to pass it on to Dan to address a couple more items.
Thanks, Rebecca. So while the initial wording of the Flexibility Act may not have indicated this will be the case, the new revised interim final ruling that Dave referenced that was released last night did confirm that 60% of the loan forgiveness amount must be attributable to payroll costs and up to 40% on non-payroll costs. So if 60% of your loan amount are not used for payroll costs, the borrower can still get partial loan forgiveness. So this is really just very beneficial for businesses that may have been closed for some short period of time where they had no employees, but they still had expenses such as a rent payment or utilities throughout the last couple of weeks or months. Now that 75% threshold that had to have been spent on payroll has been reduced to 60%. So very beneficial for borrowers, and especially in some specific industries.
Thank you, Dan. Yeah, when I opened up and talked about some favorable changes for once we get to bring to everybody, these are two of the big things that come to mind. There's more, of course, but the potential to expand from 8 weeks to 24 weeks and the ability to have a little less dedicated to payroll costs, even though that's the intent of this law is for payroll. We're just finding that a lot of companies were struggling to ramp back up fast enough to get up to 75% payroll. So before I hand it back over to Rebecca, the thing I like to mention at this point, when Dan and Rebecca and all of us talk, is as this becomes more flexible, it seemed like prior to this law, the PPP program stalled out a bit, in that there's a little over $100 billion left in the program available. And what we've seen is a lot of folks have, I think, kind of pumped the brakes on applying because it did get pretty complicated, some tight timelines. So what we fully expect is that with more of these flexible rules and timelines and wages, that more people are going to be applying. And certainly if you haven't, we would definitely invite you to talk a little bit and plan a little bit to see if the program now makes more sense for you. So with that, we'll keep the ball rolling here. Rebecca, I'll hand it back over to you to talk about a few more changes.
Thank you. So the safe harbor rehire exemption that we had previously mentioned June 30th, and that's been pushed back now with the Flexibility Act, has been pushed back to December 31st. So this applies to a business who had a reduction in employment or their wage levels between February 15th and April 26th. And there's some specific guidelines in there about what we have to meet in order to be eligible for the safe harbor exemption. But being able to have that date pushed back to December 31st can be a huge advantage. Like Dan mentioned, businesses may not be up and running at the same capacity as they expected to by the end of this month. So maybe having it pushed back to December gives us more time to get our business back into the flow of things and be able to meet those safe harbor exemptions.
So moving on, there's also a couple other changes with this Flexibility Act, and keep in mind, it is called the Flexibility Act. The SBA and Treasury are trying to make things easier for borrowers to get full loan forgiveness. A handful of opportunities already existed to obtain full loan forgiveness, even if your employment levels decreased during your covered period. And the Flexibility Act actually created 2 additional exemptions. And these are related to just the reduced full-time equivalents as opposed to the reduction in wages. So the first is you have the inability to rehire your old employees, the employees that you had on February 15th, and you are not able to hire similarly qualified employees before December 31st. So that's the first additional exemption instituted as part of the Flexibility Act. And then the second one is the inability to return to the same level of business activity that you were operating at prior to COVID. We may need some further guidance when looking at levels of business activity. The Flexibility Act language is rather vague, but does include compliance requirements established by federal organizations, and that the level of business activity was reduced or was related to the maintenance or standards for sanitation, social distancing, and other worker safety requirements related to COVID. A little vague, a little stringent at the same time, so we're looking for further guidance to help clarify that exemption. But nonetheless, these do provide borrowers some much needed relief when employment levels do decrease for one reason or another to obtain that maximum loan forgiveness.
So Dan, I think it's important that you hit the key things that changed, but we do know there was some key things that actually stayed related to these rehire exemptions. So could you, that's one thing I would like us to hit today, even though we've kind of referred to some of the prior webinars for other material. Can you please hit on that real quick?
Yep, so can we go to the next slide real quick? There's a couple FTE reduction exemptions that were already existing from previous guidance that's also available. And these are, if you try to get an employee to come back to work and they refuse for one reason or another, then as long as everything is documented and you report them to the unemployment office, you can exclude them from your FTE calculation. You will also not have a penalty or a reduction in forgiveness for employees that were fired for cause, voluntarily resigned, or voluntarily requested and received a reduction of hours. So there's many outs, for lack of a better word, that allow borrowers to obtain that full loan forgiveness, even if they have employment levels reduced for a certain reason.
Thanks, Dan. And the reason I wanted to put this slide in there and for us to talk about it today is in almost every one of our prior webinars, we received various questions kind of skirting around or directly at this issue in terms of employees that couldn't come back, wouldn't come back, were fired, were on some kind of leave. So really wanted to hit this key point that on top of the Flexibility Act, these exemptions make it a bit more flexibility in terms of those scenarios in which, folks couldn't come back or didn't come back, or fired for cause, those sort of things. So even though this wasn't existing, I didn't want us to hit it because of that reason.
No matter the exemption utilized, it is important to document whatever exemption you're using and why, to support your claim for reduced FTE levels and getting that full forgiveness.
Dan, that brings up a great point, and we'll talk kind of throughout or embedded throughout, in terms of achieving maximum loan forgiveness. One of the key things that you hit on is that throughout, whether we're documenting wage levels, full-time equivalents, what we're spending on payroll, rent, utilities, and other costs, solid documentation this entire time through your covered period, whether it's 8 weeks or 24 weeks, solid documentation is one of the key steps to maximizing your loan forgiveness on the back end when we do apply for it. So thanks, Dan. I'll hand it back over to Rebecca to cover a couple more key provisions specific to the PPP program before we switch gears a little bit.
Yeah, so another huge item with the Flexibility Act is that the loan period now is expanded from 2 years to 5 years. So that's the case for any new loan that's coming out since the initiation of the loan. Any PPP that is already out there before June 5th, you can work with your lender to consider modifying the terms on that existing loan. So that's something that you're going to have to work with your lender on, because it was established at one point. So this is a change going forward, but existing loans you need to discuss with your banker. So this will give us some liquidity relief looking forward, going down the road, that will hopefully give us a little more cash flow, and we'll know how to plan out for that cash flow a little better as well. And then next, so this is another item that the Flexibility Act brought to us, that we are required to apply for forgiveness within 10 months of the end of our covered period. And the previous law was in place that payments were due starting 6 months after the end of the covered period. But with the Flexibility Act, now we're able to defer those payments until we receive forgiveness, or recipients who do not apply for forgiveness have 10 months to begin making payments from the end of their covered period. So again, this is going to help us with cash flow, looking down the road, planning for making these payments on the non-forgiven portion of the PPP.
Thank you, Rebecca. So, up until this point, or I should say kind of the summation up to this point, is we focused on the key areas that have changed as part of the Flexibility Act from Friday. So again, these are the key things that changed. There's more behind the PPP program. Again, feel free to reference any of our prior webinars or materials on those. What I'd like for us to do now, and as you can tell, we've got a very expert panel today, and what we've been doing as a team internally is, with these changes, even though they just came out, been trying to come up with the best strategy or some planning oriented tips related to the Flexibility Act as that would apply to your PPP loan strategy. So since I like to pick on Dan the most for some reason, Dan, I'm going to pick on you again. It's probably because of that dapper haircut you've gotten. I mean, you've really shaped it up. I really like that. The extra hair gel really goes a long way.
And then the mop head from earlier, huh?
Yeah. All kidding aside, Dan, can you talk through some of the strategy items we've been talking about the past couple days?
Absolutely. So the Flexibility Act brought flexibility in and of itself to the PPP program. What it also did is create some additional questions and provide for some different strategies to at least consider. The one being, do I use the 8-week period, if you're allowed, or the 24-week period? From a lot of people I've talked to recently, everyone's default mindset seems to be going towards, well, I have 24 weeks, I'm going to use 24 weeks. Now, that's going to be the right decision in a lot of cases, but in some cases it might not. So there's some things you want to consider before making this decision. How much of the PPP funds have you used so far? If you've used all of them, well, we may want to consider what things look like now as opposed to 24 weeks from now or 16 weeks from now to get to the end of the 24 period. Are you on pace to maintain your average FTEs during the 8 weeks? If so, you may jeopardize forgiveness if you are now required to maintain FTE levels for an additional 16 weeks without the PPP funds, since they could be fully exhausted. Things to consider, if you're not on pace to average the full-time equivalents that you're needed to, then it makes it very likely that the 24-week period is going to be the viable option, as well as utilizing a potential rehire exemption date of December 31st. Then, I kind of alluded to earlier, but will you be able to maintain FTE levels for a prolonged period of time? Because we know PPP funds are likely not to extend all the way for 24 weeks. So after your funds are run out, what is your employment levels looking like for the balance of the covered period? If you're planning to use the rehire exemption anyway, because you had a dip in employment levels or full-time equivalents, then since that date now got extended to December 31st from June 30th, it's likely that you will benefit from the 24-week covered period as opposed to the 8. It gives you additional time to use funds if you haven't used them all, as well as additional time to restore your employment and wage levels to December 31st when you're looking back at the period or the time frame February 15th that you need to restore employment levels and wage levels to. Not all cut and dry like it may seem. 24 weeks sounds way more appealing. In certain instances, it will be, but there are also instances where you will benefit from the 8-week period. So it's very important if you're coming up on your 8-week period now to consider the options and see what is your best covered period to utilize.
Dan, all great points. I think when the House originally passed the bill almost about 2 weeks ago now, I think everybody rushed to the conclusion that 24 weeks has to be better than 8 weeks, right? But the more you do a little bit of planning into the bill, into the law, it might not be the case. The one thing that I'll throw on top of all the great planning points you put out there is, for lack of a better term, the headache factor. I know a lot of folks are really close to full forgiveness or pretty close to full forgiveness in their 8 weeks. If they extend it out, they might be able to get to 100% forgiveness, but I think we showed that crazy roadmap of 32 stops along the way. I think people on the 32nd stop are saying, I'll throw up my hands. I'd rather just take my 8 weeks, have a small loan, and just be done with this thing. So that's the headache factor I always throw in there with talking with folks is, is it worth your time and energy to extend it out? That's for the business owner to decide. But I've talked with a number of folks that are considering it from that perspective too. Just I kind of want to be done with this and move on.
One additional comment to that on Dave is, if you're utilizing the 24-week period and potentially the December 31st rehire exemption date or safe harbor date, you may not be able to apply for loan forgiveness, till the fall or maybe even towards the end of this calendar year. It could take up to 4, 5, 6 months to get ultimate approval of loan forgiveness from the bank and SBA, at which point you may have filed your 2020 tax return at that point. Keep in mind, there is still some discussions around the ruling that the IRS sent out saying the expenses you used for the PPP loan forgiveness are non-deductible. That could change as the time goes on, and we just want to be cognizant of more than just looking at when can I spend my money, 8 weeks or 24 weeks. There's a handful of other factors to consider, and crossing 2 calendar years can certainly provide a little headache, I would think.
Dan, I agree with you 100% on that last point. And we've had a lot of discussion internally about this tax deductibility ruling that came out several weeks ago, and how switching between tax years could really overcomplicate things. One thing you hit on that honestly is a pretty good segue, and we'll use it as such to hand things back over to Rebecca, is you mentioned, when can I actually apply if I elect the 24-month period? So that's somewhat of an ambiguous question up for interpretation at the moment, but there are some other questions, surprise, surprise, out of this act that are still unanswered. So Rebecca, could you hit on a couple of the key ones we've been talking about? And then, as we've done in the past, these are unanswered questions. We need more guidance, but if you don't mind giving a little insight as to what we're thinking and a little bit of guidance, just kind of based on the way we're interpreting things.
I'll do my best, Dave.
Thank you.
So, like you mentioned, with the Flexibility Act comes a lot of flexibility and comes plenty more questions. So these questions on the PowerPoint now, we don't have answers to. These are things that we are looking for, we are seeking, and we will be sure to update you through our COVID resource page on Anders' website as soon as we have information on these items. So the first one that Dan and Dave have kind of mentioned already is, when can I apply for forgiveness? So maybe I looked forward and it made sense with my FTE counts and the status of my business currently. Maybe it makes sense to do 24 weeks for a covered period. However, my funds are spent up by the 16th week. Do I have to wait 8 more weeks to apply for forgiveness? We don't know. So that's we're expecting to see a revised application for forgiveness coming down the road. That hopefully will help answer some of these questions. The next question, will FTEs and employee compensation be compared to the full 24 weeks or a date any earlier? I think that's exactly what Dan mentioned. We don't know yet. If I'm able to maintain my FTEs for 8 weeks, but I'd rather spend my funds over the 24 weeks, what's that look like for my FTEs and my salary reduction, the 25% salary reduction clause? I'm not sure what that's going to look like. I think that's something that we need some more guidance on, and maybe Dave, you can pick up there, but I think that's a question, and that's going to make a big difference for a lot of our clients and for a lot of businesses out there. Another question.
Rebecca, sorry to interrupt there, but looking for an opinion, I think that if you elect the 24 weeks for your covered period, I don't see how you can't use that 24 weeks when looking at your FTE counts. I know it's still a question that has not yet been addressed with clarity, but I'm leaning towards that. I think it's going to be that full 24-week period where you're comparing your FTE levels.
Thanks, Dan. It's a really good point. So moving on to our third question, how are FTEs calculated on or before December 31st for the safe harbor exemption? So this is something that didn't even necessarily cross my mind, but December 31st is a time when a lot of businesses will close, or a lot of employees will take time off. How do we consider that in looking at the December 31st date for the safe harbor exemption? My guess is that it's going to be based on a time period, maybe the last payroll for the year, or the payroll that includes December 31st. But again, there's a lot of dates in there, a lot of holidays that we're looking at that could affect what our actual employee counts look like at that time. And then the last question on the slide is, will previous limitations on owner compensation increase from 850 seconds to 2450 seconds? To me, this is a huge question. You know, we have employee compensation limited to the annualized amount of $100,000 a year. So if we're limited to 850 seconds, that's $15,300 and some dollars that we can pay each employee, and the 2450 seconds would bring that up to $46,000 and some change. So that's quite a large difference if we're looking at an employee. If we're looking at an owner employee who can be paid the lesser of $100,000 annualized, or the annualized amount of their 2019 compensation, I think this comes into effect too. And I know of plenty of clients that have already stumbled over that. That was a later rule that came out for the owner employees. So if that is expanded to the 2450 seconds, I think that will offer a lot more relief than the 850 seconds. I'm personally hoping that that's the case. That's just guidance that we're waiting for more guidance on.
Thank you, Rebecca. So, you know, each of the 32 stops along the map, we've expected to not have any more questions, and not to be surprised, here we are today. We've got some more questions, but you know, I do think the key takeaway before we switch over to a little different topic is that it's embedded in the name of the act, the Flexibility Act. This does make it a lot more flexible for business owners and businesses. As I've seen by some of the questions coming in and getting answered, and thank you everybody for all of those, we do appreciate it, is even though we think this is clear, or Congress thinks this is clear, it's not 100% clear, which is evident by some of the questions coming in, and evident, you know, by some of the questions that Rebecca talked about. So as always, as we learn more, we're going to share it with you via all of our various channels. So definitely stay tuned there. but keep the questions coming in today, and always feel free to follow up with us after the webinar. So the next topic is actually in the PPP Flexibility Act, but it's not really a change per se to a specific loan provision. But what it does is change the way that those that use PPP funds on payroll, which is what you're supposed to use it for, how companies are now able to take advantage of one of the earlier stimulus bills related to payroll taxes. So our colleague Chad's really been one of the point people here at the firm studying these different payroll deferrals and benefits. So Chad, could you elaborate a little bit on what changed in the act and what it means for folks?
Sure, thanks Dave. Yeah, the change to the program under the PPP Flexibility Act for the payroll deferral eliminated the provision that made the PPP loan recipients with forgiven in debt ineligible to defer payroll tax payments. So how does this impact the businesses? Well, this is just another adjustment that can create some short-term liquidity and cash flow relief, allowing them to defer payroll tax payments down the road, which a colleague Dan will talk a little bit more about cash flow here shortly. The original PPP language did not allow taxpayers to defer payroll taxes once the forgiveness was granted. So as you can see from the slide there, the deferral period is from March 27th through December 31st, 2020. We also provided a link that the IRS has on their website, some frequently asked questions that they've been tracking and getting. But basically how the program works is employers, if you move to the next slide, are not required to deposit or pay their employer's share of the Social Security tax that's otherwise due in that deferral period from March 27th through December 31st. And so that's their share of the 6.2% Social Security tax on wage base, which for 2020 is $137,700. Now this does not exempt them from not filing the Form 941 payroll returns. They're still required to file. In fact, the IRS has a draft form. They're going to add a separate line that you can back out this deferral piece. It's supposed to come out for the second quarter of 2020. It hasn't been released yet, but as you can see at the bottom of the screen, basically you'd have to repay the deferred taxes over a 2-year period in order to avoid any penalties. 50% would have to be paid by December 31st, 2021, and then the remaining amount by December 31st, 2022. All employers are eligible to do this. There's no dollar cap on wages up to the wage base, and even self-employed individuals may defer a payment of 50% of Social Security tax on their net earnings from self-employment income. So again, this is just another opportunity for business to help maybe improve their cash flow and on the short-term basis and reduce their current payroll tax per employee. So with that, I think I'll hand it back over to Dave.
Thank you, Chad. So the questions kind of have evolved over time, but the first set of questions when PPP came out did relate to some of the other stimulus benefits this program or the payroll tax deferral included. So it was, in our eyes, really good news to have it come out in the CARES Act. Chad did use the word deferral a number of times, but I like to reiterate in talking with clients and with businesses that it truly is a deferral. It's not a forgiveness. So the payroll taxes will still be due. It's just due next year and the following year. So the payroll taxes will still exist. It's just when we get to pay them. And as Dan Mudd will talk about in a little bit, anything we can do right now as we, as a country slowly emerge and reopen the economy, anything we can do to extend our runway, extend our cash flow is going to be beneficial for us. So this is a key program, I think, in extending that runway for folks. So the next topic we'd like to talk about, because it hasn't gotten that much attention yet, and that's because the program came out and then it was quickly foreshadowed, or quickly overshadowed, I should say, with the PPP program. But that is another loan program called the EIDL loan program. This is the program where we're starting to see folks that applied before PPP now all of a sudden getting money, and the money just kind of magically shows up in your account one day, which has been very interesting to watch. It's kind of nice to see your bank balance increase, but a lot of people have asked why. So Paul is going to elaborate on what this program is and some more details, just because it hasn't been covered in that much that much detail yet. So Paul, I'll hand it off to you, sir.
Thanks, Dave. My counterparts here on the phone know that I'm covering a couple different things here, but you're not going to get me off the webinar without giving me an opportunity live to talk about the PPP and spend a couple of minutes from a banker's perspective. Most of you that have been on the webinars know my background. And one of the things I think that we have done very carefully is that if we don't know something, we're not afraid to say that we just don't know that. We'll give opinions. We went back to an earlier slide of several things. I talk about the 850 seconds versus the 2450 seconds for self-employed individuals, and I think we all have an opinion that that's probably going to change, and I feel like it should change to the 2450 seconds. I think there's a consistent belief that it will, but we could very well get to the end of this thing without an IFR that clarifies that at all. So we're going to tell you what we think we know, and we're also going to tell you when we think that we don't know it. I had opportunity to visit with two bankers this morning just to kind of get some of their thoughts about where they're at in the process, because that's a little bit of an unknown, and I know we have some good banker friends on the line here as well on the webinar. And nobody wants forgiveness more for you than your banker does. The banker doesn't want to hang on to a 1% loan, nor do they want their good clients to be saddled with additional debt. So they're really of the mindset that when they can get the opportunity and get the appropriate documentation from the SBA, that they're ready to move this thing forward. Obviously, as businesses, all of you need time to gather the appropriate documentation together, make sure you've put the best package together. And I think that's where we encourage clearly our clients to let us help you a bit through that process, because it is in your best interest, because again, the banker is going to receive a completed package from you, and if it's thorough, it's well thought through, they're gonna do some due diligence on it, but there's no way, and nor are they required statute wise to go through every item in that package. They want to move this on. They want to get it out, get it to the SBA. Heard one banker say this morning, we have all had time to rest a bit and think about where we're going, because obviously forgiveness applications need to be simplified a bit. So we know where we're going to head with this thing. We've already told our employees, no vacations. We're going to work in shifts. We're going to do everything to get these applications forgiven for our clients and move forward. Now, I don't know that any of us have the confidence that once it gets to the SBA that they're not going to take their full 90 days. I would think they would want it forgiven as well, but the volumes that will come through will probably be pretty striking. But at this point, I encourage you to begin that process, thinking about where you want to be at a certain point in time. Have people review those documents before they get to the bank. And then the bank, as I said, they're chomping at the bit to get these things forgiven, moved on, so that things can get back to normal. The only thing I would indicate as well is that there was some conversation out of the Washington Bureau yesterday of the business journals. They had an SBA regional director on who did clearly indicate that there is another application coming, that it's going to be a simpler application. Don't know exactly how to believe that, but it sounds like great news. And she also reiterated that there will be several more IFRs coming out. So it sounds like to me that those questions that we had about 4 slides ago are questions that a lot of people have. And through each one of those, I think we'll see more IFRs. So I think we're starting to get to the end of that point. So I would encourage you, if the decision is right for you to be finished with it, if you use your money, and the 8-week period is right for you, utilize it instead of procrastinating and moving it forward. So let's talk about the economic disaster re-injury loan just a little bit, the EIDL program. It came out actually before PPP, and what was really supposed to happen is that particular product was supposed to be in place before PPP. So what you're doing is you apply for an EIDL loan. You applied for it online, couldn't go through your bank. And in that request, you were allowed to request an advance or a grant, for lack of a better term. Typically, those were $10,000. Shortly after people started applying, then there was some SBA guidance around the fact that they were going to have to restrict that because they were running out of money. They hadn't been the allocation from Congress hadn't been increased in any way, shape, or form. So things got a bit crazy, and then it just stopped. Everything stopped dead, and I know tongue in cheek, but the EIDL program went idle. It just died. People couldn't get into the system. It took another 5 to 7 days. So all of a sudden, the grants that you were promised within 3 days and the loan that you were promised within 12 to 14 days disappeared. So we even had clients forget that they had went through that process, or they got halfway through the process and thought they got kicked out and just sort of disappeared because the PPP program hit full force, and that's where everyone's focus was. The goal was to give you your grant, to have an EIDL loan in place for you, so that when the PPP loan came into play, your EIDL loan could be part of that payoff, part of that process moving through. It was always going to still be a loan, but you could, in theory, refinance that with your PPP loan, get forgiveness for all the PPP, and then carry your EIDL loan through the different terms with the organization, though that obviously didn't happen. So that relationship just fell apart between two specific products, same organization, SBA, but two specific products. So they quit talking to each other, for lack of better terms. So it was supposed to work one way. It actually worked the other, where folks were getting grants while they were getting their PPP loans. They weren't worried about that because the promise that they were given was that $10,000 EIDL grant or the advance did not have to be repaid. So we're not going to worry about that. If we don't get an EIDL loan, that's okay. We got our grant. So the reason this has become a topic, why we're talking about this again, is, as Dave mentioned earlier, all of a sudden, the $60 billion that was allocated for that program, somebody's trying to figure out how in the world to get that spent. So we've got clients that are getting confirmations that your money is ready to be deposited. They hadn't even signed a document quite yet. They had to click on, get the document, make some certifications, move forward. We even had one client, and I completely understand why they felt this way, but they felt it was a scam. They didn't even realize they had, I think, either forgot or it had been so long ago that it just didn't feel right that all of a sudden here was this money coming your direction. So obviously we assured them that it wasn't a scam, and that if it's appropriate for them, they certainly could take that and utilize it. If not, if they felt like that they didn't want the additional debt, then they could certainly decline that and move that on. So we're seeing more and more of that. The EIDL program right now, when you get online, is directed really for agricultural organizations. They've even closed it off for additional applications outside of that. At any given time, you can go on, and that may be an incorrect statement, but right now, the last several weeks, it's been associated with the agricultural loans. So the real question is, and what many of our clients were calling us and asking is, well, what we're seeing is in the last IFR from the SBA is that if you received an advance, it has to be identified on the application for forgiveness. But the interesting part of that is they also made the comment that the amount of money that you're forgiven that the SBA is going to pay the bank will be less the amount of your EIDL advance. But in the actual application, when you go through the calculation, there is no place to subtract that. So that would have to be done at the SBA. So folks started thinking back about that. And if you put two and two together, if you have a $150,000 PPP loan and a $10,000 EIDL grant, the bank submits the application for forgiveness for you for $150,000. The SBA gets that application, cross-references your $10,000 advance. They send $140,000 back to your bank for forgiveness, and somebody's left holding $10,000. Who is that? Is that the client or is that the bank? I can assure you that the bank has no intention of holding that, and I don't think they want their clients holding it. But there's a gap right now, because if you go out on the U.S. Treasury website, you could do that right now. It clearly states that the EIDL advance is not to be repaid. It's not to be an additional debt for the borrower. So the U.S. Treasury, who the SBA reports to, says one thing, the SBA says the other. We believe that there's an unintended consequence here, and somewhere in this process, it will get fixed in the next several IFRs, but we can't guarantee that. But that question's been asked so many times. At this point, you have to think common sense prevails, that forgiveness is forgiveness. And you would think the U.S. Treasury would override that from the perspective of the SBA as well. So can I say that's going to happen 100%? No, but I can tell you that it makes a whole lot of sense. And the more conversations that are coming out of DC is that that hole has been identified. It's going to be a long time before you get forgiveness, so there's a long time for that to get fixed. So I wouldn't lose a great deal of sleep over that right now. So that's it on the EIDL. And what we wanted to make sure is that we address that again, because that literally now has become a conversation that's happening almost as much as the PPP. Though it's a smaller amount, it's concerning for folks.
Hey,
so let's
Paul,
talk. Yeah, sorry. Go ahead.
Real quick, and Destiny, if you don't mind going back to the EIDL slide real quick. We've had a few questions popping up about this program, and since we've not spent a lot of time in prior webinars, I wanted to address those. You mentioned that right now the only new EIDL loans are for agricultural businesses. Ask you to put your speculative hat on here. Do you think at any point they'll open it back up for other businesses, or do you think we're stuck with just agricultural-based businesses now?
I would speculate that the reason it's agricultural businesses right now is because the backlog that the SBA is dealing with probably has eaten up the amount of money that has been allocated by Congress. That's pure speculation, but it makes sense because that's how the process has worked from beginning to end. I think when they get through the glut of applications, I think people will be receiving EIDL loans for the next 60 to 90 days that they may have applied for back in March and early April. I think once they start to get through that and they find additional money that it isn't taking it all up, then there will be some communication that says it's opened back up. And literally 5 days ago, I popped out there and there was an opportunity for people to get in and get a certain way through. Then it went back to the agricultural piece. So I would just say that we need to wait and see, but I'm sure that backlog has caused that.
So completely understand. And one more question, because this has started coming up with a lot of business owners I've talked to, either clients or just through other organizations, is some folks are seeing the money show up on their bank account, which means they were approved. Other folks are receiving a letter in the mail or a letter from the SBA saying they were declined, and they have a chance to appeal. I know those decline letters can be for a number of reasons, but do you have any advice from the ones you've seen or the ones you've worked with in terms of how to best position your appeal to go back to the SBA? Because I think you only get one shot to do it, don't you?
Well, I think it depends on the specific letter. We've only seen a couple of them at this point, and there is an appeal process. And clearly, it's very difficult to determine why, without a great deal of explanation, why a company may have been declined. Typically, if there's been some issues with the SBA in the past, a delinquent loan, those types of things get declined because it really isn't specifically based on underwriting, whether you can afford it or not. They do have some checks and balances if for some reason you've applied in the past. So I think, Dave, we would have to see that specific reason why, because it's hard to be turned down for an EIDL if the reason is legitimate. And frankly, you didn't have to prove that. You did have to provide some documentation. But as of yet, this is just really early on. The only thing I would caution people about is that, number one, the SBA does not talk to you on the phone. So if you get somebody talking to you on the phone about your EIDL loan or asking you to sign some documents, don't do that, because that typically would tell you that that's probably a scam, and we've seen plenty of those out there. The first communication literally should have been an email. And when you click on it, there are many people that have clicked on it, really didn't realize what they were clicking on, but that was their acknowledgement, signing the note and moving forward. So they can always return that. But any communication that comes back is in the form of a letter, and I certainly would ask people to take that to their financial advisors, and certainly if you're a client of ours, we would want to see that first before you start communicating with the SBA.
All right, thank you. Thanks, Paul, for addressing those on the fly. Didn't mean to knock the wind out of your sails. Nope. I think those were key to talk about since we've been getting them so often. I'll let you continue on your way to talk about the Main Street program, because again, this is another one like EIDL that hasn't been talked about that much, but could have some pretty significant benefit behind it for companies. So I'll hand it back your way.
Yeah, I'm just going to take a few minutes, and then we'll turn it over to Dan here in a little bit, so we can finish on time. But the reason we're talking about this is it has started over the past 2 weeks becoming more of a conversation. This is a program that's through the Fed, it's through banks from an application process, but it isn't in operation yet. And it's had a lot of hiccups. They announced it several months ago and came through the process and changed it. About 5 days ago, they sharpened their pencil again to make this more appealing, lowered the loan amounts, increased the terms for the loan. So, we have a blog out there that says, the Main Street lending program, is it for my business? Because we think people need to be real cautious about this. Most banks right now are a little cold on this product, only because they remember back in 2006 and 7 when the troubled asset program happened, where banks needed to be bailed out a bit, and they were partners with the federal government. But when you do that, borrowing money from an organization, they put certain restrictions on you, and this is no different. The Main Street lending program has restrictions for the clients, and banks aren't overly comfortable when their clients are restricted from a compensation perspective and those types of things. So I think they're taking the right approach right now. Banks are waiting to see if the Fed is going to sharpen that pencil a little more. But this will look more like a conventional type product from an underwriting perspective. There are 3 different types of loans: new, priority, expanded. At this point, LIBOR plus 3%. We won't go into the details of what LIBOR is, but right now, on a 1 or a 3-month LIBOR, anywhere from 13 basis points up to 33. So you could see loans running from 3.13 to 3.35 right now, and they're variable rate loans. So they do have a reasonably attractive price because there is risk, maybe a little higher than your bank can do. But what I think the stance banks are taking right now, and I'm hoping my banker friends out there are sort of nodding their head, they would rather take care of you as a client on a conventional loan perspective to try to get it done that way, a little more flexible terms. But in the event that this thing gets a little better and they move forward with it, it's going to be difficult for banks to be comfortable to lend people 6 times their EBITDA, which is an accounting number that banks love to use that talks about the revenue and the profitability of a company. Banks don't typically lend to those levels. So they're looking at a client's EBITDA at 2019, and they're giving pretty high multiples of that. So you can get loans. The government will take 95% of the risk. The bank then takes 5%. So that entices them a little more to do that. But I think at this point, it's a program that's still a little bit in flux. And as of yesterday, it had not come into operation. They were talking about mid-June. I'm thinking probably later June before that happens. We've got a blog out there. We've got this slide that talks about the repayments, so I don't want to go into that a great deal. But I think the most important thing is before you head down the road, get with your financial advisor, let them talk to you about the constraints that you have as a business that you have to adhere to. And if you feel like that's the only way for cash flow, we have a client right now whose revenue reduction 60%. In 2019, they were a strong company, and they'll be a strong company again. But the problem is, at a 60% revenue dip in the next couple of months, it's going to be difficult for their bank, and the bank's already said that to them, to provide any sort of conventional financing. So this may be the only way to get the bank comfortable with providing additional capital for this company to survive, because we know mid-2021, this company's going to look strong again if the economy continues to do in that sector what it's done. But they're going to need some help for 6, 8, 10 months, and this may be the way to go. So just want to make sure people, every time we're talking about PPP, we always want to talk a little bit about what's next. So we encourage lengthy conversations, and you've got time to walk through that. As I said, it isn't operational yet. So I could talk all day, but I better stop right now. And Dan, I want to let you talk about some cash flow issues, and we'll go from there. Dan, we can't quite hear you yet.
Dave, are you still there?
We're here.
Okay, I thought Dave was going to hand it over to me. I appreciate the handoff, Paul. We're kind of in an unusual environment right now. We collectively, all of us, have never been in an economic environment like this before. When have you ever heard the words lock down the economy or open up the economy? We've never heard that. And I hope we never hear it again, honestly, right? But everything that we've talked about the EIDL loan, we've talked about the PPP loan, we've talked about the Main Street Lending Program loan, we've talked about payroll tax deferrals. Everything that we're talking about is about cash flow. And everything comes back to cash flow when you're talking about small businesses and surviving past the 8-week or 24-week covered periods. So what can you do to make sure that your business thrives and survives? So, I mean, what you don't want to do is use all the money that you received under these loans and have a short-term outlook. And then once you use all that money up, plus whatever you already had, and then your business fails. Well, that wouldn't be a good use of your money. So it does cause you to, if you've never done it before as a small business owner, it causes you to think outside the box because we've never been in an environment like this before. And you should be looking at short-term and long-term cash flow projections. When I think short-term projections, I think 3 to 6 weeks. When I think long-term, I think out to 3 months. And what I like to do is start with what I got in the bank, which probably includes some of your loan money. And then you start plugging in what your fixed costs are, what are my next 2 or 3 payrolls, what's my next 2 or 3 rent payments, utility payments, your fixed costs, your overhead, to get down to your break-even point. And then from there, you can start plugging in other factors to see where you're going to end up, because it's never going to be your best case scenario. It's never going to be your worst case. It's going to be somewhere in the middle. So that's what you need to look at to make sure that you're using your cash wisely and that you're not going to burn through it during the covered period. And then you don't know what to do once you get out of your covered period. So working on your short-term and long-term cash flow projections for planning purposes is a key part to getting through this, hopefully short-term and one-time crisis that we're all going through. One of my other partners, Scott Hoffman, wrote a very nice blog that's on our COVID-19 Resource Center. It's called 10 Tips for Managing Cash Flow in a Crisis. Some of these we probably practice normally in our businesses, and maybe some of them we haven't. One of the main ones that I like to point out is to establish a deeper relationship with your banker. If you've never had a good relationship with a banker, hopefully you will now, and kind of use them as part of your critical thinking team, whatever you want to call it, when you're talking about your business and making a major decision. And then you've got your normal things like managing your accounts receivable, managing your accounts payable and your payment terms, maybe adjusting your inventory levels. Review some of your agreements to see if there's anything that you can do to defer some payments with certain vendors. You might delay some of your capital improvements and investments. And again, back to cash flow planning and looking at your short-term and long-term cash flow projections. And looking at all those tools, along with keeping your accounting up to date. And up to date is, trying to close your month within a week or two after month end and not being 1 or 2 or 3 months behind. All those tools taken in, you can then use those financials and projections and planning points to run your business, make decisions so that you won't be surprised and that you can keep moving forward and get past this short-term crisis. So cash is king. We always talk about it, and everything that we have been talking about is all about cash flow planning, deferring your loan payments, getting into the right loan, talking to your banker, and just make common sense when it comes to your business, and to make sure that you do survive and thrive through this short-term crisis. Dave, I think that covers my piece. I'll hand it over to you.
Well, thank you, Dan, and thank you, everybody. Thank you, Dan Schindler, Dan Mudd, Rebecca, Chad, Paul. Really appreciate the time you dedicated to this webinar today, and to everybody on the webinar. So in closing, as I open, thank you all for joining us. We know you all have a lot that you can be doing with this hour, so hopefully valuable for you. A lot of Q&A coming in. Our colleagues, Jane, Lori, and Abigail, fielded a lot of those. If we didn't get to you, please feel free here on the contact slide to contact any of us on the team. We'd be happy to follow up with you. And I suppose what we'll close with is, they do call it the Flexibility Act for that reason. It does make things more flexible, and I think that's important to end with. This is our time as a business owner to pause a little bit, to take a second, and now we've got some time to play with to hopefully make some more strategic business decisions than we were forced to before. And with that, I will say, I do tend to pick on my colleagues a little bit. We like to have fun around here, but please don't take that as any indication that this is not a serious topic, and we don't take it that way. It's very serious economically, so we're here to help you. We like to have fun doing it. And with that, we'll sign off for the day, and wish you a great rest of the day.